Deutsche Bank just lost 3 million ounces to JP Morgan. Bank's panic purchased 2% of global supply. The CME delivery reports reveal something the financial media refuses to discuss. A transfer so massive, it represents 2% of the entire planet's annual production, moved in a single documented transaction. But this is not about silver. This is about survival. When Deutsche Bank surrenders 3 million ounces to their largest competitor, when JP Morgan abandons a 40-year suppression strategy, when the banks who created the game suddenly start breaking their own rules, the question is not why they are buying. The question is, what do they know that you do not? The vault inventories are collapsing. China has sealed the export door, and the metal is gone. This is not a market movement. This is a countdown. Welcome to Currency Analyzer. You know, when my grandfather used to read the financial papers each morning, he would always say, the banks never panic unless the ship is already sinking. If you have been in business long enough, if you have seen enough market cycles, you understand that the most important warnings are the ones spoken in silence. So, before we decode what just happened between Deutsche Bank and JP Morgan, may I ask you something? Would you take just 2 seconds, the time it takes to sign a check, and subscribe to this channel? Because the analysis we are about to share is not available on mainstream financial television. And one more thing, I am curious. From which corner of the world are you watching this? London, New York, Singapore, Mumbai? Drop your location in the comments, because economic tremors are felt differently, depending on where you stand. Now, let us begin the investigation. On January 2nd, 2025, a transaction occurred that most people will never hear about. The CME Group Delivery Report, a document that typically generates 0 headlines, contained a number that made veteran traders stop mid-sentence. 3 million ounces of physical silver transferred from Deutsche Bank's vault directly into JP Morgan's possession. Not paper contracts, not derivatives, not synthetic exposure. Physical metal, bars stacked in registered vaults, move from one institution to another in a single coordinated delivery. To understand why this matters, one must first understand what 3 million ounces actually represents. The global mining industry extracts approximately 800 million ounces of silver annually from thousands of mines, scattered across dozens of countries, operating every single day of the year. 3 million ounces represents 0.375% of that total annual production. But the title of this investigation states 2%, because 3 million ounces was not the only metal that moved. When analysts examined the full COMEX delivery data for the first 48 hours of January, the complete picture emerged. Multiple banks, multiple transactions, all moving in the same direction. The total volume, standing for delivery in those first 2 trading days, reached 17.23 million ounces. That is when the percentage becomes truly significant. 1723 million ounces divided by 800 million annual global production equals 2.15% in just 48 hours. Before most institutional traders had even returned from holiday vacation, the COMEX system was forced to deliver over 2% of the entire year's global silver supply. This is not how commodity markets typically function. Under normal conditions, the vast majority of futures contracts are settled financially, not physically. A steel manufacturer might buy contracts to hedge against price movements, but they receive their actual metal from established supply relationships, not from exchange vaults. The futures market exists primarily for price discovery and risk management. Physical delivery, especially in large, concentrated blocks, is the exception, not the rule. Yet here stands the data. Deutsche Bank, one of Europe's most systemically important financial institutions, released 3 million ounces. JP Morgan, America's largest bank by assets, took possession of that metal and more. The mechanics of this transaction follow established COMEX procedures. When a futures contract reaches expiration, the holder must decide, settle financially, or stand for delivery. Standing for delivery means the buyer demands physical metal. The exchange then issues a delivery notice, matching the buyer with a seller who has metal in registered vaults. Registered vaults are the key term here. COMEX maintains 2 categories of inventory: registered and eligible. Registered inventory is metal that has been warranted by the exchange, certified for quality, and made available for delivery against futures contracts. Eligible inventory is metal stored in COMEX-approved vaults, but not currently available for delivery. Only registered inventory can satisfy delivery obligations. As of early January 2025, total registered silver inventory across all COMEX vaults stood at approximately 39 million ounces. This number has been declining steadily for months. When 1723 million ounces get delivered in 48 hours, that represents 44% of the entire registered inventory base. Nearly half gone in 2 days. Deutsche Bank's 3 million ounce contribution to this drain was documented in the issuer reports. Issuer reports identify which banks are delivering metal out of their positions. Stopper reports identify which banks are taking delivery. JP Morgan appeared prominently on the stopper side. This creates a critical question that traditional market analysis cannot easily answer. Why would Deutsche Bank, an institution with decades of precious metals trading expertise, release such a substantial physical position? And why would JP Morgan, historically known for maintaining large short positions in silver futures, suddenly reverse course and demand massive physical delivery? The price on the screen that day was $30.21 per ounce. But price tells only part of the story. Availability tells the rest. Because when institutional buyers are willing to navigate the complex delivery process, pay storage fees, arrange vault logistics, and lock up capital in physical metal rather than maintaining flexible paper positions, they are not trading, they are not hedging, they are securing. And when the banks themselves begin securing physical inventory from each other, the natural question becomes, what do they see coming that requires metal in hand rather than promises on paper? There's a number that keeps shrinking, and nobody is talking about it. 39 million ounces. That is the total registered silver sitting in COMEX vaults as of early January 2025. To most people, that sounds like a lot of metal, but context changes everything. The United States Mint, just one government entity, consumed over 30 million ounces of silver in 2024 alone, producing coins that retail investors purchased faster than they could be minted. So the entire registered COMEX inventory, the metal backing the world's primary silver futures exchange, would barely satisfy 1 year of demand from a single mint. Now consider what just happened. 1723 million ounces delivered in 48 hours. The mathematics become uncomfortable. If this delivery pace continued for just 4 more days, the registered inventory would be completely depleted, 6 days total, and the vaults would be empty. Of course, no analyst expects this exact pace to continue without interruption. But the trajectory is undeniable. And this is where the story becomes truly unusual. Because the registered inventory crisis is not new, it has been building systematically since mid-2020. In June 2020, COMEX registered silver inventory stood at 137 million ounces. By December 2023, it had fallen to 68 million ounces. By September 2024, it dropped to 45 million ounces. Now, early January 2025, just 39 million ounces remain. That is a 71% decline in less than 5 years. And the decline is accelerating. What makes this particularly concerning is the distinction between eligible and registered inventory. Total eligible silver in COMEX vaults still amounts to approximately 250 million ounces. So the metal exists, it sits in approved vaults. It could theoretically be converted to registered status. But it is not being converted. This is the mystery that traditional supply-demand analysis cannot explain. If registered inventory is running dangerously low and delivery demand is spiking, why are the vault holders not simply converting eligible to registered and collecting delivery fees? The answer reveals something about ownership and incentive. Eligible inventory belongs to private entities, banks, funds, wealthy individuals who are storing their metal in COMEX-approved facilities. But they have not warranted that metal for delivery. They have not made it available to satisfy futures contract obligations. They are holding it off-market, using the COMEX vault infrastructure, but keeping it out of the delivery system. This suggests these holders do not want to sell, regardless of current prices. They are not interested in collecting premiums. They are not interested in trading. They are storing and waiting. Now layer in another element that makes the inventory crisis even more severe. Industrial demand. Silver is not just a monetary metal or investment vehicle. It is critical industrial commodity with applications that cannot be substituted easily. Solar panel manufacturing requires silver paste for photovoltaic cells. Electronics manufacturing uses silver in virtually every circuit board. Medical devices incorporate silver for its antimicrobial properties. Electric vehicles contain significantly more silver than traditional combustion engine cars. Global industrial demand for silver in 2024 exceeded 540 million ounces. That is 67% of total annual mine production. Investment and jewelry demand consume most of the remaining supply. The market operates with razor-thin surplus, typically less than 50 million ounces annually. Any disruption to supply or spike in demand immediately creates shortages. And now observe what is happening in the retail physical market. Bullion dealers across North America and Europe are reporting delivery delays extending into March and April 2025. Premiums, the amount buyers pay above the spot price, have expanded dramatically. In normal market conditions, retail silver bars might trade at $2 to $3 per ounce above spot price. In early January 2025, premiums reached $6 to $8 per ounce, and in some cases higher. The screen shows $30 per ounce. but actual transaction prices for physical metal are approaching $38. This is called a disconnect. When paper prices and physical prices diverge by 20% or more, it signals that the price discovery mechanism is breaking. The futures market is supposed to reflect the true supply-demand balance. But when physical buyers cannot obtain metal at the futures price becomes meaningless. It becomes a reference number, detached from reality. History provides precedent for what happens next. In 1980, when the Hunt brothers attempted to corner the silver market, COMEX changed the rules mid-game. They implemented Silver Rule 7, which prohibited new long positions and forced liquidation-only trading. The market collapsed, but the exchange survived. In 2011, when silver spiked to $49 per ounce, exchanges raised margin requirements 5 times in 8 days. Leveraged positions were forced to liquidate. The price fell 30% in 4 days. In March 2020, when COVID created delivery chaos, COMEX approved 1,000-ounce bars as deliverable against 5,000-ounce contracts. They changed the rules to prevent a default. The pattern is consistent. When physical delivery pressure threatens the exchange's ability to function, the rules change. But changing rules has consequences. It destroys confidence. It reveals that the paper market cannot actually deliver what it promises. And this is why the January 2025 delivery surge matters so profoundly. The banks are testing the system. They are forcing the exchange to prove it can deliver. And with each passing day, with each million ounces that leave the registered vaults, the system moves closer to the moment when it must choose. Default, or change the rules again. But this time, there's a variable that did not exist in 1980, or 2011, or 2020. This time, the eastern supply door has been locked from the inside. December 3rd, 2024, Beijing published a document that received almost no coverage in Western financial media. Announcement on the adjustment of export control measures for certain dual-use items. Buried in the technical language, between clauses about gallium and germanium, was a single provision that fundamentally altered the global silver market. Silver and silver-based products would now require export licenses. Only 44 companies, pre-approved by the Ministry of Commerce, would be authorized to export precious metals from Chinese territory. No announcement, no press conference, no explanation, just a regulation published on a government website that severed the world's largest silver supply artery. To understand why this matters, one must understand China's position in the global silver ecosystem. China is not just a major producer, China is the refinery. In 2023, Chinese refineries processed over 180 million ounces of silver. Some of that came from domestic mines, but a substantial portion came from imported concentrate. Raw material shipped from mines in Mexico, Peru, Australia, refined in Chinese facilities, then re-exported as finished bars. China serves as the bridge between mine production and market demand. When silver prices rise in London and fall in Shanghai, arbitrage traders would buy metal in China and ship it west. When prices inverted, metal flowed east. This constant rebalancing, this swing supply, kept the global market liquid. It prevented regional shortages from becoming systemic crises. The December 3rd regulation ended that mechanism, not gradually, not with transition periods or exemptions, immediately. By early January 2025, the effects became visible in price spreads. The Shanghai Gold Exchange silver price, which historically traded within 50 cents of COMEX prices, began showing premiums of $2 to $3 per ounce. That spread represents trapped metal, silver that exists in Chinese vaults, that shows up in global inventory statistics, but cannot reach Western buyers. It is functionally removed from the available supply. Now, add another layer to this calculation. China is not just refining and exporting silver, China is consuming it. The nation's solar panel manufacturing sector, which produces over 80% of the world's photovoltaic modules, consumes approximately 140 million ounces of silver annually. China's electronics manufacturing, from smartphones to servers, requires another 60 million ounces. Domestic jewelry and investment demand adds 40 million more. Total Chinese silver consumption, approximately 240 million ounces per year. Chinese domestic mine production, approximately 100 million ounces per year. The mathematics reveal a structural deficit. China needs to import 140 million ounces annually just to meet internal demand. So the export restriction is not simply about controlling outflows. It is about prioritizing domestic supply security. The Chinese government looked at the trajectory of industrial demand, looked at the availability of domestic resources, and made a decision. Silver stays inside Chinese borders. Western markets must solve their supply problems without Chinese help. This explains the timing of Deutsche Bank's delivery to JP Morgan. The December 3rd regulation gave sophisticated institutions approximately 30 days of warning. 30 days to read the policy documents. 30 days to run the supply models. 30 days to understand what was coming. And then, the first trading days of January, the scramble began, because once the eastern supply door closed, the only accessible silver remaining in size was sitting in COMEX registered vaults, 39 million ounces. That is not a strategic reserve. That is not a comfortable buffer. That is barely 6 weeks of global industrial consumption. History offers a parallel that institutional analysts immediately recognized: rare earth elements. In 2010, China controlled 97% of global rare earth production. Western manufacturers, particularly in defense and technology sectors, relied entirely on Chinese supply. Then, during a territorial dispute with Japan, China restricted rare earth exports. Prices spiked 500% in 6 months. Western governments scrambled to restart dormant mines. Manufacturers redesigned products to reduce rare earth content. It took nearly 5 years for supply chains to adjust. But rare earths and silver are different in one critical aspect. You can redesign a motor to use less neodymium. You cannot redesign a solar panel to use less silver and maintain efficiency. You cannot redesign a circuit board to eliminate silver without sacrificing conductivity. The substitution options are limited, which means when supply constricts, users must secure inventory at any price or shut down production. And this is where the industrial sector intersects with the banking sector delivery surge, because large industrial users, the solar manufacturers, the electronics firms, the automotive suppliers, do not buy silver on COMEX. They have long-term supply contracts with refineries and distributors. Those contracts assume metal availability. But what happens when the refineries cannot source material? What happens when Chinese exports stop? And Western mine production is already committed, and COMEX inventories are draining. The refineries and distributors face a choice: default on delivery obligations, or go into the COMEX market, stand for delivery, and secure physical metal at whatever cost necessary. Some analysts believe this is already happening, that beneath the surface of Deutsche Bank and JP Morgan's documented trades, there are industrial entities desperately securing supply through intermediaries. Because if a major electronics manufacturer or solar panel producer runs out of silver, production stops, contracts default, revenue disappears, share prices collapse. For a CFO facing that scenario, paying $35 or $40 per ounce instead of $30 is not expensive. It is survival. Now, layer in the geopolitical dimension. China's export restriction did not occur in isolation. It is part of a broader strategy of resource nationalism. Gallium and germanium, critical for semiconductors, restricted. Graphite, essential for batteries, restricted. Antimony, used in defense applications, restricted. And now silver. The pattern is clear. China is weaponizing supply chains, not through military action. Through regulatory control of strategic materials, Western governments are beginning to respond. The United States is exploring domestic silver production incentives. Canada is fast-tracking mining permits. Australia is expanding refinery capacity. But mines take years to develop. Refineries take years to build. And the inventory crisis is happening now. In January 2025, with 39 million ounces in COMEX vaults and 17.23 million ounces delivered in the first 48 hours, the mathematics are simple, the timeline is short, and the banks, who have spent decades managing this market, who understand supply chains better than anyone, are not waiting for government solutions. They are taking metal, now, from each other. For 40 years, the silver market operated under an unspoken agreement. The banks worked together, not explicitly, not through documented conspiracy, but through aligned incentives and coordinated behavior that kept prices manageable, volatility contained, and physical delivery rare. This arrangement served everyone's interests. Miners could hedge production. Industrial users could lock in supply costs. Traders could speculate on price movements. And the banks, the market makers, collected fees on every transaction while maintaining enormous short positions that generated profits when prices declined. The system functioned because nobody challenged it. Nobody stood for delivery and size. Nobody forced the banks to produce physical metal. The futures market remained primarily a paper mechanism, a pricing tool, disconnected from the actual flow of physical inventory. But in January 2025, something fundamental changed. The banks stopped cooperating, and they started competing. The evidence appears in the issuer and stopper data. These reports, published daily by the CME, identify which clearing members are delivering metal and which are taking delivery. Under normal market conditions, these reports show a predictable pattern. Bank A delivers metal to Bank B. 2 weeks later, Bank B delivers metal to Bank C. A month later, Bank C delivers back to Bank A. The metal moves in circles. Positions shift. But the actual bars rarely leave the vault system. It is a paper shuffle with physical documentation. This circular pattern serves a purpose. It creates the appearance of a functioning delivery mechanism without actually depleting inventory. It allows the futures market to maintain credibility while keeping most contracts settled financially. But the January 2025 data shows something completely different. The metal stopped moving in circles. It started moving in straight lines, out of Deutsche Bank into JP Morgan, out of HSBC into Scotiabank, out of multiple smaller institutions into 3 or 4 large accumulating banks. This is not market making. This is not hedging activity. This is competitive acquisition. And it represents a complete breakdown of the traditional cartel structure. To understand why this matters, one must understand the role that concentrated short positions have played in precious metals markets. For decades, a small number of banks maintained enormous short positions in silver futures. These positions, often totaling hundreds of millions of ounces, dwarfed the physical inventory available for delivery. Critics called this manipulation. The banks called it market making and hedging. Regulators investigated periodically, but never took decisive action. The arrangement persisted because it was collectively maintained. As long as all the major banks held short positions, none of them had incentive to force delivery and break the system. It was mutually assured destruction in reverse, mutually assured stability. But stability requires trust. And trust requires the belief that all parties will continue honoring the implicit agreement. What happens when that trust breaks? What happens when one bank looks at the China export data, looks at the inventory drawdown, looks at the industrial demand trajectory, and decides the paper game is ending? The bank faces a choice. Continue holding short positions in a market heading toward physical shortage, or close those positions, reverse course, and start accumulating physical metal before the price discovers its true supply-constrained level. The first bank to move pays a cost. They must buy back their shorts at a loss. They must compete for physical inventory in a tightening market. But the first bank to move also gains an advantage. They secure metal while it is still available. They position themselves for the repricing event that comes when paper and physical markets fully disconnect. The second and third banks to move face worse conditions, less available inventory, higher prices, more competition, and the banks that move last, the ones still holding massive short positions when the registered inventory reaches zero, face potential default. This is why the January delivery surge is so significant. It is not just about the volume of metal moving, it is about what that movement reveals regarding bank behavior. JP Morgan's positioning is particularly notable. For years, JP Morgan appeared prominently in the concentrated short position data. Regulatory reports showed them holding short positions that critics claimed were impossibly large. But starting in 2020, something shifted. JP Morgan began appearing more frequently on the stopper side of delivery reports, taking metal, accumulating physical inventory, building a long position. Some analysts estimate JP Morgan now holds over 1 billion ounces of physical silver across various storage locations. If accurate, that represents more than 1 year of total global mine production, stored, off-market, controlled by a single institution. This is not market making. This is strategic accumulation. And it suggests JP Morgan reached a conclusion about the silver market's future trajectory and positioned accordingly. Deutsche Bank's behavior tells the opposite story. In 2018, Deutsche Bank announced it was scaling back its precious metals operations. By 2020, they had largely exited market-making activities in gold and silver. The January 2025 delivery of 3 million ounces appears to be Deutsche Bank liquidating remaining physical positions, exiting completely, stepping away from a market they no longer want exposure to. Two institutions, two completely opposite strategies, one accumulating, one exiting. This divergence is the fracture, because when market makers stop making markets, when the institutions that provided liquidity withdraw, when the banks that maintain the paper structure start competing for physical metal, the entire pricing mechanism becomes unstable. Consider the mathematical reality. If just 3 major banks decided to take delivery of 50 million ounces each over the next 6 months, that is 150 million ounces. COMEX registered inventory is 39 million ounces. The shortfall is 111 million ounces. Where does that metal come from? There are only 3 possibilities. First, eligible inventory gets converted to registered, but as discussed previously, eligible holders are not converting, they are holding. Second, the exchanges raise margin requirements and change delivery rules to discourage physical settlement. This has been done before, but it destroys market credibility. Third, the exchange defaults on delivery obligations or implements forced cash settlement. This has never happened in COMEX history, but that does not mean it cannot happen. Each of these outcomes has profound implications. If the exchanges change rules to prevent delivery, it confirms that the paper market cannot support physical demand. Every industrial user, every strategic buyer, every institution that needs actual metal will immediately recognize that futures contracts are unreliable. They will seek alternative supply sources. They will pay premiums. They will hoard inventory. The disconnect between paper and physical pricing will accelerate. If the exchange actually defaults, the consequences are even more severe. A default would essentially announce that the world's primary silver price discovery mechanism is broken, that the price on the screen, the reference price used in thousands of commercial contracts, is fiction, that real silver trades at a different price, determined not by exchange transactions, but by private negotiations between parties desperate for physical metal. This is not theoretical speculation. This is risk analysis based on observable trends. Registered inventory declining 71% in 5 years. China closing export channels. Industrial demand remaining structurally high. And now, banks competing rather than cooperating. The final element that makes this situation particularly unstable is timing. This is not occurring during a period of economic calm. This is occurring as global debt levels reach historic highs, as central banks navigate the tension between inflation control and recession prevention, as geopolitical tensions between East and West intensify, as trust in institutions and currencies faces unprecedented challenges. In this environment, precious metals serve a specific function. They are the asset of last resort, the store of value when confidence in paper systems erodes, and when the banks themselves, the institutions that created and managed the paper precious metals markets, begin abandoning their own structure and competing for physical metal, they are sending a signal about what they expect, a signal about which assets will matter when the current monetary architecture faces its next severe test. Deutsche Bank delivered 3 million ounces to JP Morgan. That is the documented fact. But the significance extends far beyond those specific institutions or that specific transaction. It represents a visible marker of an invisible transformation. The transformation from managed markets to competitive scramble, from paper confidence to physical preference, from cartel coordination to individual survival. The banks are no longer working together to maintain the game. They are working against each other to secure the lifeboats. And when institutions with trillion-dollar balance sheets and unlimited analytical resources behave this way, individual observers might want to ask themselves a simple question. What do they know that has not yet appeared in mainstream analysis? What are they preparing for that has not yet been publicly announced? And most importantly, when the music finally stops completely, will there be any metal left for those who waited too long to act?